Ever wonder how governments can inject trillions into the economy without printing a single physical dollar? Stock markets soar. Mortgage rates drop. Groceries get more expensive. You hear phrases like stimulus and money printing. But the real engine behind it all, it's something called quantitative easing, and it's one of the most powerful tools in modern economics. Let's break it down. Welcome to FinTech Central. This is Byte-Sized Intel, where we simplify complex tech and finance topics with no fluff, all in under 3 minutes. Let's get into it. So, what is quantitative easing? It's a fancy term for a simple idea. The central bank creates new money and uses it to buy stuff, mostly government bonds, sometimes other assets too. It's like the Federal Reserve has a money cannon, only instead of handing cash to people, it uses that cash to buy things from financial institutions. But why would they do that? Let's zoom out. The economy is like a car engine. Sometimes it stalls, like during a recession or crisis. Normally, central banks restart the engine by cutting interest rates. Lower rates equals cheaper loans equals more borrowing and spending. But when rates are already near zero, there's no room left to cut. That's when they pull out the emergency lever, quantitative easing, or QE. Here's how it works, step by step. The central bank, like the Fed, creates digital money out of thin air. It uses that money to buy bonds from banks and large institutions. That injects cash directly into the financial system. Now banks, hedge funds, pension funds, whoever sold those bonds, have fresh cash. That cash isn't just sitting around. It gets lent out, invested, or used to buy more assets. It's like the Fed pours water into a dry sponge. The sponge is the financial system, and the goal is to get it flowing again. What happens when they buy bonds? When the Fed buys lots of bonds, bond prices go up, yields, interest rates go down, borrowing gets cheaper for everyone. That makes it easier to get a mortgage, a car loan, or start a business. Cheaper credit boosts the economy. But quantitative easing doesn't just help borrowers. It also nudges investors. If safe investments like bonds pay less, people start chasing riskier assets. Stocks, real estate, even crypto. That's why quantitative easing often leads to rising stock markets, even when the economy is struggling. So does it work? Sometimes, yes. Quantitative easing helped prevent a total financial meltdown in 2008. It was used again in 2020 to cushion the blow from COVID. It's helped lower borrowing costs, stabilize banks, and keep credit flowing. But it's not a silver bullet. What are the downsides? Here's the problem. Quantitative easing creates money, but it doesn't guarantee that money reaches everyday people. A lot of that cash stays in the financial system. It props up asset prices, but may not boost wages or jobs in the real economy. And when too much money chases the same goods and services, prices rise. That's inflation. Add in corporate price hikes, supply issues, and rate lag, and quantitative easing can quietly fuel the cost of living crisis. Here's a real-world example. Let's say you're the Federal. You buy $1 trillion in bonds. Banks now have $1 trillion more in cash. They lend it, invest it, or push it into stocks. That pushes markets up. But if supply chains are still broken, and there aren't enough homes, cars, or groceries to go around, all that extra money just drives prices higher. That's how stimulus can backfire, even if it was meant to help. So what's the bottom line? Quantitative easing equals money creation, bond buying, lower interest rates, higher asset prices, and potential inflation. It's designed to jumpstart a stalled economy when rates alone won't cut it. But it can have ripple effects that benefit the wealthy more than the average person. And once it starts, it's very hard to unwind. This has been Byte-Sized Intel. If you learned something new, hit like and subscribe. And check out the rest of the series for more sharp, simple explainers, right here on FinTech Central.